Welcome to another video of financial indicators by Fahad M. Gohar. This is going to be the video number 13. Today's subject would be the current account. What does it mean? This indicator actually is vital for understanding, the financial flow between countries and help shape, of course, decision in global trade policy and investment strategy. It is a critical financial indicators that reflect countries' international transactions. It tracks the flow of goods and services and income and current transfer in and out of a country. Government usually closely monitor the current account. Why? In order to adjust the macroeconomic policy, because a persistent deficit can indicate the need for adjustment in fiscal policy, such as, of course, altering interest rate or enacting trade policy to address imbalance. So now let's see what exactly the definition of the current account. We either have a surplus, which means a positive balance, which indicate the country is a net lender to the rest of the world. A surplus country may attract more investment due to strong fundamentals. Or it might be the deficit. Deficit is a negative balance. It means it's a net borrower, that country. A deficit country might see investors demand higher return. Why? Due to increased risk. So that's the definition of the current account. Either you have a surplus or you have a deficit. So now let's look at the categorization of the current account and how we categorize it. We either have a low surplus, that will be a deficit, of course, or we have a high deficit, which will be very risky, or we have a high surplus. So either we have a low surplus and deficit, or we have a high deficit, or we have a high surplus. So now let's see the effect of the surplus on the aspect of economy. Let's go first for the market confidence. Of course, a surplus, signal a strong trade position, potentially boosting the market confidence and the local currency and attract investors. So the market confidence goes up. How about the interest rate? Of course, a surplus can lead to a lower interest rate since there is less need for foreign capital. So the interest rate doesn't need to go up, but it will go down. How about the bonds? What's going to happen to them? Of course, the bond price will rise. Why? Bond sees a boost, of course, as a strong current account improve the country credit worthiness. So people will go and buy bond from that country, so the bond price will go up. How about the currency? What will happen to it? Of course, a surplus may lower inflation, which is very good, by increasing the availability of foreign currency and lowering import cost. So the currency value will go down. How about the government debt? What's going to happen to it? A surplus, of course, can reduce the need for external borrowing by the government, to subsidize its activities. So, and in order to stabilize the debt level, so the government debt will go down. So the government doesn't need to borrow more money. How about the corporate earning? Of course, company benefit from a surplus when exports are high, which increase the earning for those companies, so the corporate earning goes up. How about the stocks? Of course, stocks and corporate earning are attached to one another. The stock price, of course, will rise because a surplus can positively affect stock particularly for export, driven company, as it shows strong demand for the country global goods, so the stock will go up. Now let's see what's the benefit, what's the effect of that deficit on that country economic aspect. Let's start with the market confidence first. What will happen to it? Of course, a deficit can weaken the currency, which may harm market confidence, so market confidence will go down. How about the interest rate? Of course, if a country runs a deficit, the government may raise interest rate to attract foreign investment and finance that deficit, so the interest rate will go up. Now how about the currency and the inflation? Of course, a deficit could contribute to inflation, as the country may need to import goods, which will lead of course to a higher price domestically. So what's going to happen to the currency and the inflation? They will go up. How about the government debt? A current account deficit may increase the government need to borrow, which will add to the national debt, so the debt for the government will go up. How about then the stock prices? What's going to happen? Of course, stock prices here will fall, as a deficit might hurt stock, particularly if the country has to raise interest rate to attract capital, so stock prices will go down. How about the corporate earning? Of course, stock prices goes down. What's going to happen? A deficit, however, can squeeze corporate margin if the country becomes too reliant on expensive import, so corporate earning will go down. How about the bonds? Of course, the bond here will fall. A deficit might hurt bond, particularly if the country has to raise interest rate to attract capital, so now the bond price will go down. This gives you an idea about the effect of the surplus and the effect of the deficit side by side. Now let's look at some charts for demonstration. As you can see, effect of current account deficit on interest rate. Interest rate here, it's this color here, a straight line, and then the inflation and the market confidence, and that's a current account, and you can study it and see how it affects from year to year accordingly. And let's go look for this other chart also, current account versus government debt. As you can see, the current account, see the current account as it goes down, of course the debt goes up, and then current account versus corporate earning, so this way you can visualize what's going on, and it's straightforward, so it's easy to understand. So I hope this small video can help you to understand what does it mean current account. See you in the next video.